Bitcoin's biggest correlation is with global liquidity, and it follows global liquidity better than any other asset. So better than stocks, better than gold. And there's a couple of reasons for that. One is stocks obviously have other variables, things like earnings that can impact their pure correlation with liquidity. Gold it doesn't have those earnings, but it does have some risk off aspects to it. So sometimes in a worsening liquidity environment, gold can actually catch a bid just because people want to get out of other things. Bitcoin has the highest correlation directionally with liquidity. I'm fairly bullish on liquidity with a 12-month view.
In today's video, we'll dive into Lynn Alden's latest insights on the state of the money supply, how it bottomed in 2023, and what it means for the economy moving forward. According to Alden, while the Federal Reserve's balance sheet has remained relatively flat, the Treasury's actions and the draining of reverse repos are influencing liquidity levels. Alden highlights that, although money supply is gradually increasing, it's not at a pace that would indicate rapid economic growth. It's interesting to note that because of this difference in monetary and fiscal policy, investors are gravitating toward defensive assets like Costco and Walmart and away from high-growth sectors like tech and cryptocurrency. We'll analyze the implications of this for investors and determine whether this trend points to a changing economic environment or a potential recession. If you find these insights valuable, don't forget to like this video, subscribe to the channel, and turn on post notifications for more updates on the latest financial trends.
I think most pools of capital treat it as a risk-on asset. Obviously, there are people that are very enthused with the fundamentals and then know that you can hold your own money and move around the world, and so it's got those risk-off properties. But in terms of pricing, most pools of capital treat it as a risk-on asset. I actually just so I worked with Sam Callahan. I commissioned a research report from him, and he wrote this report. It's on my website now that maps Bitcoin to measures of global liquidity. And we found that Bitcoin's biggest correlation is with global liquidity, and it follows global liquidity better than any other asset. So better than stocks, better than gold. And there's a couple of reasons for that. One is stocks obviously have other variables, things like earnings that can impact their pure correlation with liquidity. Gold it doesn't have those earnings, but it does have some risk off aspects to it. So sometimes in a worsening liquidity environment, gold can actually catch a bid just because people want to get out of other things. Bitcoin has the highest correlation directionally with liquidity. I'm fairly bullish on liquidity with a 12-month view. There's a couple ways to do it. Michael Howe of Cross Border Capital has a more proprietary method of measuring global liquidity. We used global M2 that's denominated in dollars. And so basically there's two components there. One is the pace of credit creation, so the pace of more M2 units, broad money hitting the market. Mm-hmm. And then the other one is what is the dollar index relative to those. And the reason that's relevant is because so much debts internationally are denominated in dollars. And so the dollar kind of weakening can make global liquidity go up in dollar terms, which are relevant relative to their leverage units.
Right. So it's done on M2, not M0.
Yeah, M2, broad. And so my base case is, we've been in this consolidation. I think we're probably going to grind higher in the next 12 to 18 months in global M2. And I think, and when you look at various measures of valuation, I think that Bitcoin probably grinds higher in that time, is my kind of base case.
And what's your base case for NASDAQ slash tech stocks? And I use that as a proxy for growth stocks. What is your proxy the same, that they're a function of global liquidity?
Yes, I'm a little more concerned about those because in addition to being correlated with liquidity, related to the state of the economy and their earnings and their revenues and consumer strength. So I do have concerns about the Teslas, the Apples of the world at their current valuations, and even Nvidia. As much as I think that they're going to keep selling more and more GPUs, I think you can go through pockets of softness where a lot of entities bought all these GPUs that are not making money from them, and they can scale back their purchases for a period of time until they kind of figure out how their business model is going to work. And so, I don't really have a high conviction view on these big tech stocks, other than that I don't love the risk reward at these valuation levels and this kind of state of economic softening. And if anything, they're treated like they're actually more treated like risk off assets, which is people say, I don't know what I want to own out there, but I don't want to own commercial real estate, and I don't want to own cyclical things. So I want to buy Apple, and I want to buy Nvidia, and I want to buy these big cash rich entities that are super profitable. And if anything, there's already a lot of capital stuffed into those, which concerns me. I've been using the 3 pillar portfolio, which is one pillar is equities, another pillar is cash equivalents, things that are kind of protect you in one of those like liquidity risk off cycles, and then the other pillar is commodity producers and sound money that can do well in debasement and inflation cycles. So you have this kind of protection from different scenarios. My base, and to George's point, I think it largely depends on whether we get a liquidity pocket or not. My base case is that we've probably already seen a liquidity pocket, and that I kind of view this more like that 2001 cycle. But you can only be so sure about that type of outlook. And so I think that we kind of, a lot of these other assets probably over time grind sideways to up in this scenario. And if we do get a recession, I would think that, in any sort of liquidity pocket, most assets go down. And if you don't get a liquidity pocket, then I think that basically things with earnings struggle, whereas things that don't have earnings, like gold and Bitcoin, that are more like responsive to liquidity, they probably do pretty well.
So how do you position yourself?
Yeah.
Well, how do you break down? Let's just take a $1 million portfolio. How do you break it down? Where do you put the money?
So I mean, it depends on your risk tolerance. I put a lot of it in equities, a good chunk in gold and Bitcoin, a decent chunk in that kind of energy producer category, and then a smaller chunk in cash equivalents, things like short-term treasuries, money markets, T-bills.
What percentage?
Short-term tips.
What percentage, under the fact that you're, relatively risk, that you're willing to take relative risks at the moment, what percentage would you be invested? What percentage would you be in cash and cash equivalents?
So for me, I have something like 15 to 20% in those cash equivalents. If I was obviously near retirement, I'd probably dial that up to some extent. But this comes down to whether or not someone's a high turnover trading portfolio or a more strategic evergreen portfolio. Mine is more evergreen, so I only make small marginal adjustments. Like I lean a little bit toward risk, or I lean a little bit toward risk off, rather than making these big sweeping changes about what I expect to occur over, say, the next 12 months.
Alden wraps up by examining the broader liquidity landscape, pointing to the key roles played by the Federal Reserve, the Treasury General Account, and reverse repo operations in managing the money supply. Since the regional banking crisis in 2023, liquidity has mostly flattened, and Alden believes this trend will continue until the Fed starts gradually increasing its balance sheet around 2025. She compares this to similar Fed actions in 2019 after a spike in the repo market. While liquidity is expected to rise, Alden cautions that it will likely be a slow process. Tightening bank lending further complicates things, contributing to a disconnect between fiscal and monetary policies. This divergence makes it challenging to determine if the economy is slipping into a recession or just starting to recover. Let's hear her following words.
Money supply bottomed in 2023 and has been slowly grinding up, partially because we have kind of the Treasury offsetting the Fed. Active Treasury issuance is how some economists like Nouriel Roubini have described it. Basically, the shortening of kind of the issuance of extra T-bills, the draining of their reverse repos. So when you kind of take a more aggregate picture of both the Fed balance sheet and then these other components that are out there, the TGA and the reverse repo facility, we've kind of been in this flat liquidity environment ever since let's call it the regional bank crisis of 2023. That was kind of a pain point. We started kind of going sideways rather than down after that. I expect that to probably continue until we reach the end of the reverse repo facility, and then the Fed already projects that by the end of 2025 they would probably go back to gradual balance sheet increases, not for stimulus purpose, but kind of like they did in 2019 with the repo spike that they went through. They would basically say that we've reached the bottom of ample bank reserves. We want to start going up in bank reserves and maintain ample bank reserves. I think that's the language that they're going to use to frame it. And I think that we're kind of entering that period of money supply is going up, but not particularly fast. And that probably lasts.
You got to consider the banks too, because that in and of itself, to your point, would definitely increase M2 if they're buying from non-banks. But if the rate to which the banks are lending is decreasing more significantly, then it's still going to go down. So it's definitely, you got to take a holistic view, I think is my point.
Yeah, so the bank lending component's a big deal, and that to my what I talked about before is that we went through this kind of tight cycle where if you look at senior loan officer surveys, most banks were very conservative. They were basically saying we're tightening all of our standards. And now they're tightening less than they were a year or kind of 2 years ago. We kind of went this kind of 2022, 2023 cycle. They went through this tightening cycle. There's actually evidence that they're loosening up a little bit. And that's why we have these kind of weird components. Like, in some metrics say we're headed toward a recession. Other ones are saying we literally just had a recession and we're merging out of it. And it's because you have this kind of divergence between fiscal and monetary policy and this private sector versus public sector situation. Even if you look at asset positioning, for example, Costco is trading at like 55 or 56 times earnings, right? People are not piling into the ARK stocks. They're not piling into Bitcoin. They're not piling into small caps. Most of the kind of the enthusiasm in the market is actually toward fairly defensive things. These
Yeah,
blue
they're
chips.
selling Louis Vuitton and they're buying Walmart.
Walmart's going vertical. Costco's going vertical.
Yeah, but growth is not going vertical. Yeah, but growth is not. I mean, as you say,
growth is. Yeah.
Yeah.
So I think my point is that basically we already in some ways are positioned like a recession. The credit cycle we kind of went through, and the positioning in these kind of defensive assets.
Lynn Alden talked on how the interaction between the Federal Reserve and the Treasury allowed the money supply to bottom out in 2023 and is now progressively rising. The two main elements of this flat liquidity situation are the issuing of additional Treasury bills and the draining of reverse repos. Alden anticipates that this gradual upward trend will continue until the reverse repo facility is depleted, which would probably result in the Fed gradually increasing its balance sheet by 2025, not as a stimulus but rather to preserve sufficient bank reserves. But there are complicated effects on the whole economy. Even with an expanding money supply, the dynamics of the economy are nevertheless influenced by things like stringent credit requirements and cautious bank lending. Due to the difference in monetary and fiscal policies, an unusual combination of indicators has been produced, some of which point to a recession and others to a recovery. Finally, it is evident that even while the money supply is gradually increasing, the overall economic situation is far from clear-cut. We are living in an unpredictable time, as markets are positioned defensively and banks are gradually relaxing their lending requirements. While growth might be in the offing, stability and resilience are still the major priorities for the time being. What does this indicate about the direction of investments going forward? And will we witness a move toward riskier growth strategies? Until next time, happy investing.